Hi there, this is Alvin from Dr. Wealth. It has been a while since I did the last video and because I was busy with my advisory work. But today is a special day because the Straits Times Index or STI has hit 4,000 points. Okay, you can see the day high was 4005.180, and yes, it has come down since it hit the 4,000 mark, but it is still nonetheless a significant milestone. And I want to talk more about the Singapore stock market today. And this is also the all-time high of the STI, right? So just zoom in for you. You can see that it's a historical high. The last time it was that high, around 3,800 points, was in 2007. Don't know how many of you have invested since that period, but that was at a peak just before the subprime crisis that happened in the US, the global financial crisis that unfolded thereafter that caused the global stock market rout. And it took that many years, okay, 2 decades for us to beat that high since almost 2 decades, okay, since 2007, okay. So that is where we are right now. And of course, some of you who have been holding Singapore stocks despite the lackluster returns in the past few years have started to see the light at the end of the tunnel, and this is a good time to at least give a pat on your back that you have survived the ordeal, and now you're enjoying the gains. Of course, I'll also give you some insights to whether I think Singapore stocks have more runway to go higher. So let's look at the STI ETF, right? The thing is that you can't really buy the index, and the only closest thing that you can get to investing in the index is to buy via ETF. And there are two STI ETF that's listed on SGX. One is from Nikko, one is from Spider. Right, so because the Spider one has a longer track record, so I'll just use that. Okay, it's not really a preference. All right. So this is the screenshot of the Spider's STI ETF returns of performance as of 28th February 2025. Okay, so we are now close to the end of the March 2025. Then we will have even higher returns because this month it broke the record at 4,000 points. But nevertheless, and we can see that the since inception, since 2002, the ETF or STI ETF has returned about 7.11% per year. It's not that shabby if you ask me, okay? And I definitely believe that it was the last 1-2 years where STI returns became a lot stronger that resulted in this higher annual returns. Otherwise, I think for a long time it was averaging like 5 or even below 5% per year. So those were the difficult times, and now it seems like it's over. Okay, so now likely the Singapore stock market have a lot more to look forward to. And this is also from the Spider website, and this is the $10,000 invested in 2002 since the inception of the ETF. You would have ended up with about 48,000 at the end of 28th February. Okay, this is dividend reinvested, I believe so. Right, so that is what 7% per year means when you hold on to this STI ETF. It's not a very fantastic growth if you ask me, because people argue that US stocks did better. The SPY or the S&P 500 ETF will have done like what, more than 10% per year. This is slow, okay? Granted, yes, I would say that the US performance have been good, but I want to give you some caveats, okay? Some things to consider, not just look at the face value of what the US stocks have achieved. Definitely is a great place to invest in, okay? But I'm just saying that it should not be the only place that you invest in. So let's look at one of the key things, right? So when you invest overseas, if you're a Singaporean, you spend your money in Sing dollars and your wealth is denominated in Sing dollar, it is very likely that when you invest overseas, there will be Forex. And Sing dollar tends to be very strong against many other currencies, right? Even the mighty US dollar. Okay, so this is since like 2003. The US dollar has depreciated around 20%, right? 22% against the Sing dollar, and that's a very significant decline over time. And therefore, when you invest even in US stocks, be prepared that there will be potential forex losses that will pare down some of your actual returns, your nominal returns. Okay, so this is just one thing to be cautious about. But of course, at the end of the day, even after you take into consideration of forex, the US stocks may still deliver a better return over the last 2 decades. Okay, but that's it. Right, it doesn't mean that US stocks will continue to outperform the rest of the world. And this is another history that you should know, right? Again, I don't know how long have you been investing in the stock market. There is a period of time where the US stocks didn't do very well, and that was so-called the lost decade. Just after the 2000 dot-com crisis, the US stock didn't go anywhere for the next 10 years, right? Because they met with another global financial crisis in 2007, 2008, that period, right? So if you hold on to S&P 500 for the 10 years, you actually don't really make any money, okay? But if you look at the Singapore stocks, there was a period that the Singapore stocks actually outperformed the S&P 500. That was this chart is between like year 2000 to year 2007, right? So it's about a 7-year period, right at the peak of the 2007, just before the global financial crisis, right? The blue line you see here is the MSCI Singapore ETF, and it delivered more than 100% return in that 7 years, while the S&P 500 did about 21%, okay? And this is still within the, if you give a few more years, right, the S&P 500 actually went down because of the crash and net off whatever gains they had made for that 7 years. Of course, Singapore stocks also went down thereafter due to the crisis, but the point here is that there is a long enough window or a period, 7 years, a good 7 years, that the Singapore stocks actually did well against the S&P 500 or the US stocks particular. All right, so history may repeat again. Okay, people are talking about sector rotation, talking about ex-US stock market doing well. For example, Singapore is a good example, right? Because even as S&P 500 is going down, Singapore stock is breaking record high, making it 4,000 points. So we don't know, right? Probably sector rotation is already underway. Okay, so smart way is not put all your eggs in one basket, right? Invest with this possibility that a sector rotation may happen. Okay, allocate something outside of US is possible. And let's look at the Singapore index, right? So a lot of people know that STI is very heavy on banks, okay, and that is true. If you take a look at the top 10 constituents of the index, you can see the top 3 are our local banks, DBS, OCBC, and UOB. And if you sum up their weightage, okay, if you sum up their weightage is about 50%. Okay, so about 50% of the index is by banks. And people's or investors' perception is the STI is doing well because the bank stocks are doing well. Actually, it's a yes and no, right? Yes, largely banks have done well because interest rate have risen and bank stocks have broken record high, given special dividends. That I think everybody know. And something that everybody knows is also that the REITs have not been doing well, and in the STI there's also quite a number of REITs that are as part of the constituents. Okay, there are actually other stocks. You might be surprised, right, that the top stock or the top performing stock in STI, right, is not a bank stock. Okay, let me review it to you. The best performing stock this year in the STI is actually ST Engineering. Even the top 3 is not a bank. Okay, your second is Sembcorp Industry, that's up 15%. ST Engineering is up 45%, right? And even property stock UOL is up 15%, and Singtel is up 11%. Okay, then you even have a REIT that is up 8% this year, and Wilmar up another 8%. Okay, so then you see DBS, right? So it is not true that this year's STI index is driven up by the bank stocks. Yes, they play a contribution because their weightage is huge, but there are other better performing STI components that we can see over here. And of course, it's just this year, right? What about the last 10 years? To be fair, there were some index changes along the way in the past 10 years, but I won't be able to like pick out each of them when they change. I'll just take the latest 30 constituent and I did a 10-year comparison, right? Their performance. And again, surprise, the first is not a bank. The first is actually Yangzijiang Shipbuilding, 400%, fourfold in 10 years. So Yangzijiang stock has been very strong for the past, I think not just 1 year, but 2 to 3 years, have been rallying, and not surprisingly, their total stock return, this is inclusive of dividends, over the past 10 years was about 409%. And we have our bank 300%. I think to take note is that this DBS has been outperforming the other 2 banks, OCBC and UOB. So if you take a look lower down the ranking, we see UOB at 158%, OCBC at 153%. So DBS is almost double the return of what UOB and OCBC stock have delivered. Okay, so that is one stark difference. And we also see non-bank stock, Sembcorp Industry, Singapore, ST Engineering again, almost, ST Engineering almost do a 200%, while Sembcorp almost do a 300%. Okay, so it is not true that only bank stocks are doing well. All right, and there's also a REIT, which is a Mapletree Industrial Trust, that's up 142%, which is not easy because considering that the last 2 years, REITs prices have been underperforming. Okay, yet you can still stay on this 10-year top 10 years total return, right, leaderboard. And next to, okay, of course, we have our Singapore Exchange. Okay, how can we forget? Did a very good return for the past 1 year is 48.5%, and that really boosts. Almost that 1 year delivered half of their 10-year return of 137%, almost. Again, that shows you that how bullish the Singapore stock market has been, right? Even ST Engineering was 74% for the past 1 year, DBS was 51% for the past 1 year. Okay, so that past 1 year do see a lot of big gains, right? Venture Corp is in a down cycle, electronic manufacturing, and yet the 10-year track record is still good at 135%. Last 1 year didn't do so well. The stock is actually down 8%. Okay, so these are the STI component stocks that delivered more than 100% in the past 10 years, inclusive of dividends. Right? Any surprises here? You can just keep your comments in the box below. And now let's look at some valuation. Right? So this is taken from Spider STI ETF webpage, and we can see that the dividend yield is at 4.45%. So if you ask me, an index can still give you more than 4%, right? It is not expensive. Okay, it's still attractive even from a dividend perspective. You talk about T-bills is 2.75%. You talk about CPF special account 4%. Of course, dividend stock should give you more because they are riskier compared to those assets that I mentioned just now. But that said, people are looking for yields, right? Looking for higher interest when interest rate now are falling. So it seems like, can consider some blue chip Singapore stocks. They do still give you attractive dividends. And the P ratio is at 13 times. Okay, so 13 times, is it high? Is it low? Is it fair? Later I'll have another slide to show you, right? So, but overall, if we take a look at all these metrics, right, the valuation is not demanding, even though STI hit 4,000 points. Right, so for a long time, we can say that the STI is probably undervalued. Okay, so let's take a look whether is it really undervalued. This is taken from LSEG, FTSE Russell, right? And you can see at the leftmost end of the chart, we have the PE ratio of STI at 13 times. And this was based on November 2024, right? So just now we saw is about 13.3 times. Okay, didn't really change a lot, okay? But the average past 10 years PE ratio for STI is slightly above 15 times. So that means that STI is still undervalued compared to its 10 years average. Okay, so that's how we can see that. And another thing that I want to point out is if you take a look, the so-called the blue bar is generally shorter, right, or at the shorter end compared to the other country indices. Okay, and the 10-year average also on the lower side. So that shows you that Singapore stock, even on a relative terms compared to other countries, they are not. Singapore stocks are not overvalued at all. In fact, it's probably undervalued, and even the 10-year average, I would say that is pretty suppressed, right? There could be some PE expansion. Maybe really a reasonable or fair P ratio for STI could be higher than 15 times, right? The reason why I say that is because if we compare to, say, developing countries, right, how they shouldn't have their P ratio so high, right? Because they are a lot riskier. I would say that they should be priced lower. Okay, yet they are not. And Singapore is rather stable, like politically stable, no natural disaster, etc. And yet the average P ratio is not as high as the developing countries. So this is something that I think doesn't look right. Okay, and market needs to really realize or have a very much stronger price discovery, right, in order for the Singapore stocks to be trading at its reasonable value. Okay, and there are additional drivers for the Singapore stock market to go up as well. So one is the MAS review group that look at revitalizing the local stock market, and I believe that a good part of what the Singapore stocks have rallied in the past 1 year is a result of this review group or the government action, the top-down action that they want to stimulate the stock market. So I do think that even though the measures have not been out, the market has already been pricing in some potential uplifting policy that's maybe coming in the future. Okay, so this top-down direction is of course something that is favorable, right? And it does have some impact or effect on the stock market already. And the second thing is that Singapore economy is still doing well, right? The projection for this year is still economic growth of about 2.6%. And in consideration that many of the global economies are actually slowing down, right? People are talking about slowing economy in the US or even potentially recession. And China economic growth have already slowed down over the years due to the real estate crisis, right? They're still growing well, but it's not as high as what they have experienced in the past. So coming from that global context, and Singapore can still eke out a 2.6% growth for 2025, I think that's very commendable. And also election year, right? So it should be a good year generally for the stock market, right? Give investor the confidence in Singapore's economy as well as the investment climate. Of course, I'm not a fortune teller. I don't know exactly whether Singapore stocks will go up or not, but I do see that there are factors that are driving this Singapore stock market, and it's not expensive in the first place, right? So hopefully we can end the year much higher. I don't know where we will end up, but hopefully more than 4,000 points, okay? And thanks for watching. Give me a thumbs up, subscribe to the channel. I'll see you in the next one. Goodbye.